Hey everyone, welcome back to Corporate Decoder, the place where we dissect the news behind the numbers. And speaking of numbers, Booz Allen Hamilton Holding Corporation just dropped their latest quarterly report, and let's just say it has got some interesting details to unpack. Think of this as a snapshot of where Booz Allen Hamilton stood at the end of last year, December 2025. They're a big player working with the US government, helping with all sorts of high-tech stuff like artificial intelligence and cybersecurity. So what does their financial health look like? First off, let's check out the big picture. As of the 31st of December 2025, Booz Allen Hamilton had total assets valued at a whopping $7.1 billion. Now compare that to the 31st of March 2025, they had a little more, about $7.3 billion. So a slight dip there, not a major red flag, but something to keep an eye on. On the flip side, they had liabilities, which are basically what they owe to others. For December 2025, that number was around $6 billion, down from about $6.3 billion in March. This means they've managed to pay off some of their debts, which is generally a good sign. And then there is stockholders' equity, which is kind of like what is truly owned by the shareholders after all debts are accounted for. At the end of 2025, this was just over $1 billion, an increase from about $1 billion in March. So the owner's stake grew a bit. Now, let's talk about the money they brought in, the revenue. For the 3 months ending the 31st of December 2025, they pulled in $2.6 billion. That is a step down from the $2.9 billion in the same period the year before. Looking at the longer 9-month period, revenue was $8.4 billion in 2025 compared to $9 billion in 2024. This drop in revenue is a pretty significant trend. They mention it's due to a slowed procurement and funding environment, basically meaning the government is being a bit stingier or taking longer to approve projects, and that directly impacts how much work Booz Allen Hamilton can do and get paid for. When they talk about cost of revenue, that's essentially the direct costs of doing business, like paying their employees and the benefits they get. This cost went down a bit for both the 3 and 9 month periods. Interestingly, it stayed pretty much the same percentage of their total revenue, about 45 to 48%. This suggests they're managing their direct costs reasonably well, even as their overall income decreased. Then you have billable expenses. This includes things like paying subcontractors, travel costs, and other expenses directly tied to client projects. These expenses also saw a pretty noticeable drop. For the 3 months, they were down 18%, and for the 9 months, down 10%. This likely ties back to that slowdown in government work. Fewer contracts mean fewer subcontractors and less travel. General and administrative expenses are the costs of running the company itself, like executive salaries, marketing, and legal fees. These actually went up slightly for the 9-month period by about 6%, but dipped for the 3-month period. They explain this increase with things like insurance recoveries from a past settlement, but also mention that cost management initiatives and restructuring in their civil business have contributed to changes. It seems they are trying to control these overhead costs, but some factors are pushing them up. Now, let's look at operating income, which is what is left after you subtract operating costs and expenses from revenue. This is a key indicator of how profitable their core business is. Here we see a clear trend. Operating income dropped significantly. It was down 21% for the 3-month period and a sharp 30% for the 9-month period. This is directly linked to that drop in revenue and shows that even with cost controls, the reduced business volume is impacting their bottom line. The operating margin, which is operating income as a percentage of revenue, also decreased from 12% to 9%. That means for every dollar they earned, they kept less of it as profit. Interest expense, net, refers to the cost of their borrowing. This went up a little, about 10 to 12%. They explain this is mainly due to higher interest costs on their new senior notes, the ones maturing in 2035. However, they also saw a slight increase in interest income, probably from holding more cash after issuing those notes. And then there is the income tax. This is where it gets really interesting. For the 3 months ending December 2025, they actually recorded an income tax benefit of $13 million, a huge swing from paying $61 million in taxes. The prior year, for the 9 months, it was a benefit of $10 million compared to paying $233 million the year before. This massive reduction in tax expense is largely due to a significant tax adjustment related to research and development tax credits and a foreign-derived intangible income deduction. They also had issues with reserves for uncertain tax positions, which sounds complicated, but it basically means they had a substantial tax refund coming from completed government examinations. This is a big deal as it directly boosted their net income. So with all these factors, let's look at net income, the final profit. For the 3 months, net income increased by 7% to $200 million. For the 9 months, it decreased by 13% to $646 million. The increase in the short-term period is heavily influenced by that substantial tax benefit, which masked the underlying drop in operating income. They also talk about something called revenue excluding billable expenses. This is a non-GAAP number, meaning it is not strictly defined by accounting rules, but companies use it to show a different perspective. It's basically their revenue minus those direct subcontractor and travel costs. This number also went down, but not as dramatically as the overall revenue. They use this metric to highlight their core business performance without the fluctuating subcontractor costs. They also provide EBITDA and adjusted EBITDA. These are also non-GAAP measures that try to strip out interest, taxes, and other non-operational items to show the core operating profit. EBITDA dropped significantly, reflecting that lower operating income. Adjusted EBITDA also decreased, but they adjust for things like changes in provisions for claimed costs and other corporate expenses. This shows their attempt to present a stable view of their operational performance, even amidst these fluctuations. Let's touch on how they're returning value to shareholders. They have a significant share repurchase program. For the 3 months ending December 2025, they bought back over 1.3 million shares for about $127 million. This is part of a larger program where they've authorized billions for buybacks. This shows confidence from the company in their own stock, or at least an effort to boost shareholder value through reduced share count. Regarding their future business, they talk about their backlog. This is like their order book, representing future work they have secured. Their total backlog actually increased slightly to $38.5 billion by the end of 2025. This includes funded backlog, unfunded backlog, and priced options. While a growing backlog can be a positive sign, they also caution that it does not guarantee future revenue. The government funding environment remains a significant uncertainty. Under commitments and contingencies, they discuss a few key areas. One is the provision for claimed costs, where they've set aside significant funds, $247 million, to cover potential adjustments from government audits on past costs. This is a normal part of government contracting, but it highlights the ongoing scrutiny. They also mention investment commitments and leases for future office space. They have committed to invest up to $400 million in a venture capital fund. This shows a strategy to diversify and potentially invest in future growth areas, a common practice for large established companies. The litigation section is always a scroll stopper. They're involved in various audits, investigations, and legal proceedings, as is typical for a company of their size operating in the government contracting space. They mention labor time reporting, procurement integrity, and classified information access as areas of focus. While they state they don't expect any of these to materially impact their financial condition, these are always things to watch. Changes in internal control over financial reporting. This is usually a formality, and here it's reported that there have been no material changes. This means their systems for ensuring accurate financial reporting are stable. And finally, we have the certifications from their CEO and CFO attesting to the accuracy of the filings. This is standard practice, confirming management's confidence in the report. So, what is the story here? Booz Allen Hamilton is navigating a challenging environment. Revenue is down, and operating income has taken a hit, mostly due to the government's tighter purse strings and slower decision making. However, they are managing their costs, and a big tax benefit significantly boosted their net income in the short term, even though the underlying operational picture is tougher. Their backlog growth is positive, but the uncertainty around government funding is a major risk. They're also actively returning capital to shareholders through buybacks and dividends, which is appealing to investors. Looking at the numbers, the decline in revenue and operating income is the most concerning trend. While they are managing expenses and received a substantial tax benefit this period which boosted net income, the core business seems to be facing headwinds from reduced government spending and procurement delays. The increase in interest expense due to new debt is also a point to monitor. However, the growing backlog suggests they are still winning contracts, which bodes well for the future if government funding patterns stabilize. Overall, Booz Allen Hamilton seems to be a resilient company that is being impacted by broader economic and governmental trends. The significant tax benefit provided a temporary boost, but the real test will be how they adapt to a potentially tighter government spending landscape and continue to grow their revenue and operating income. Alright, that is our breakdown of Booz Allen Hamilton Holding Corporation's latest filing. What do you think about these numbers and what they signal for the company's future? Drop your thoughts in the comments below. If this analysis was valuable, hitting that like button really helps us out, and subscribe for more deep dives into corporate finances. Don't forget to check out our Discord community, linked in the description for more discussions and insights. Thanks for watching. See you next time.